Given the tariff chaos, I want to address the two income investments that have raised the most questions in the community. Business development companies like ARCC yield about 10%. Question number one is the recent price drop cause for concern? And secondly, covered call funds like JEPQ yield about 12%. Why did you recently sell half? Before retirement, I was a landlord in my spare time, and in some ways it was like income investing, but with a lot more visits to Home Depot. If you own rental properties and there's a recession, people lose jobs, there'll be less demand for houses, and the market value of your houses will probably fall. That doesn't mean you need to sell the houses. What will happen is that instead of thinking about the 100K loss on each house, you focus on keeping the rental income flowing. Worst case, you lower the rent, but it's not going to zero, and rents don't fluctuate nearly as much as housing prices, as you can see here. Real estate is great, but in retirement, I wanted less headaches and more freedom to travel, so I sold the rentals and applied the same model to the stock market. Prices will fluctuate, but income, not so much, and that's what pays the bills. Generally, regarding this chaos, my plan is to hold the ship steady and remain on course. In other words, no radical changes. However, a few days before the tariff announcement, I did make some adjustments, basically shifting a portion of my covered call funds to credit and utilities, not because I thought covered call funds would fall in price and the other group would not, although that is what happened initially. It was based on the risk to future income. These moves amounted to a rotation in my portfolio of just under 14%. Not exactly radical, but for me, that's quite a lot. Going forward, I'll keep an eye on the market and make adjustments if necessary. To be more specific, I'm not trying to avoid price volatility at this point. It's pretty much too late for that. My focus is on the future outlook for each income stream. So let's take a look at two very different examples. Business development companies got hit pretty hard, as shown in this 1 month total return chart. This is Ares Capital, the largest BDC, and it yields roughly 10% as I record this. I'm not going to quote exact numbers because at the moment everything changes every day. So the tariff chaos hasn't shielded BDC investors from a price decline. Although to be fair to BDCs, most asset classes have been hit pretty hard since the tariffs were announced. If you can find any investment that yields 10%, has a great distribution history, and wasn't affected, then let me know in the comments. Going back to the landlord analogy, let's check the rent history for this private lender. BDCs lend to medium-sized businesses. Over the past 20 years, ARCC has reduced its distributions just once. As you probably guessed, it was during the aftermath of the 2008 global financial crisis. The distributions went from 42 cents down to 35 cents. That's a 16.67% reduction. These other blips were special distributions. Zooming out to ARCC's 20-year price history, we can see two significant dips. The second one was also bad for the stock price, but did not affect distributions. No cuts. Snowball is handy for distribution charts like this. It gives me a nice income dashboard, and the calendar function lets me see how many dollars will arrive on any given day of the month from my 3 brokerage accounts. Link in the description for the Armchair Income discount and a free trial. The distribution history for ARCC leads me to the conclusion that if the tariff chaos leads to another global financial crisis on the scale of what happened back in 2008, we could expect another reduction in distribution. What I don't expect is for the distribution to go to zero. That's because BDCs are not structured like the regular C corporations you see in the S&P 500. If you're an old school dividend investor buying household names like Wells Fargo to get that 2 to 3% dividend, you're at the mercy of the board of directors. The CFO reviews the quarterly financial statements, and if earnings are down, they may recommend a dividend cut to the board. By the way, if you're new to the channel, I retired in 2017, and that's when I got serious about researching my investments in greater depth. And this channel is where I share what I learn. I mostly focus on stocks and funds paying consistent yields of 8 to 12%. And if you'd like a copy of my portfolio, it's available via Armchair Insider. Link in the description. It's free. In early 2009, when ARCC was announcing that 16.67% reduction in distributions, Wells Fargo announced a reduction to the tune of 85.3%. So, if you were relying on that Wells Fargo dividend to pay your bills in 2009, you didn't just have to tighten your belt, you had to sell your belt or maybe boil it to make soup. 85% would have been pretty rough. The reason that ARCC didn't cut by 85% is that BDCs are structured as RICs. That structure exempts them from paying corporate income tax on the condition that they distribute at least 90% of their taxable income to shareholders. There are pros and cons to that structure. Distributing that much income makes it harder to grow the share price. The point is that they're designed to deliver their returns mostly in the form of distributions. So long as they're making money, shareholders will get most of the income. In this example, the stock price falling didn't affect the income for ARCC. Instead, the cause of the 16.67% reduction in income was the 2008 global financial crisis itself. During that period, there was less demand for loans, so the business generated less income. ARCC is one of my largest holdings, and if you'd like to learn more about it, I have a video review, but it is getting to more than 2 years old now. Time flies. This recent analysis by Jonathan Weber was published at the end of March 2025, so it's far more up to date. Jonathan writes for Seeking Alpha, which is my primary resource when choosing whether to buy or sell a stock or a fund. I'll link to Jonathan's article about ARCC in the description, and I'll put a link in there for a free trial and a discount. So, in summary, while not fun, the recent price drop for BDCs has not changed my outlook for them. I continue to hold several. I reduced my exposure to covered call index funds like JEPQ by half at the end of March, which prompted a lot of questions, so let me explain. I do want to avoid price declines like everybody, but my primary goal is to maintain consistent income. The driver for covered call fund income is different from other asset classes because it's affected by the price of the fund itself. If we go back to the BDC example, their revenue is generated by borrowing at low long-term rates and lending at higher short-term rates. The difference between the two is revenue, then you deduct operating expenses and fees to get net investment income. As mentioned earlier, almost all of that net income is distributed out to shareholders. The price of the stock is not part of that formula. If the ARCC price dips 20% for days or weeks or months, it doesn't affect their ability to generate revenue. Covered call index funds are mostly ETFs, and ETFs are structured so that the price reflects the current value of the assets in the fund. So, for example, SPYI holds each of the S&P 500 stocks. If the S&P 500 falls 20%, so does the price of SPYI. Most of the yield is generated by selling covered calls on the S&P 500 index. That yield is roughly 12% of the value of the portfolio. If SPYI's portfolio rises in value, that's 12% of a bigger number. If the portfolio falls in value, it's 12% of a smaller number. So in simple terms, if the S&P 500 falls 20%, the distributions will fall 20%. This is an oversimplification though. There are some other factors at play. First of all, daily or weekly fluctuations in the S&P 500 won't necessarily affect the distributions because the covered calls are 1 month in duration. They're also laddered so they don't all expire at the same time. So if the S&P 500 falls 10% on the 7th day of the month and recovers all of that loss the following day, it's not a problem for the income. Another factor is volatility. If volatility spikes, which typically happens during a correction, then the calls will actually bring in more revenue and distributions will increase. That's good news, but it's also a short-term benefit. Volatility tends to spike briefly. We can see here where it peaked during the pandemic. Sharply up and sharply down. So the higher revenue from selling calls doesn't last long. The important thing to understand is that the covered call income is a function of the value of the assets in the portfolio. A prolonged reduction in the value of the S&P 500 would reduce the income produced by the fund in absolute dollar terms. Or to put it another way, it would pay roughly 12% of a smaller number. That's despite the fact that the companies in the S&P 500 could theoretically continue to produce the same earnings as before. And to be fair, the dividend-paying stocks in the S&P 500 do contribute a small amount of income to that fund. The key contrast here is that market price doesn't affect BDC distributions, but can, under certain market conditions that don't happen very often, affect covered call fund distributions. Most of the time, the stock market goes up or moves sideways, and this isn't an issue. Brief corrections, also not an issue. Every asset class has their risks, and a prolonged correction is a risk to the income for covered call funds. Fortunately, risks vary by asset class, and with enough diversification, you can reduce the impact of each risk on your portfolio. Reducing my exposure to covered call funds by 50% was to reduce my total portfolio's exposure to the risk of reduced income. As I mentioned before, this wasn't a dramatic move. Those trades at the end of March were less than 14% of the portfolio. So why not sell 100% of covered call funds? Well, that would be one step closer to timing the market. A true market timer goes to cash when they think the market will fall, then reverses that decision when they think the market will rise. That's a long-winded way of saying they think they can predict the future. I didn't do that, but I did buy some fixed income and utilities because I think the income will be more reliable. All of this is predicated on my outlook for the market and the economy. I'm concerned that things will get worse, which is not a radical opinion at this point. The reason I didn't sell all my covered call funds is that I could be wrong about the market or the economy or both. We can all game out what we think will happen, but the reality is that nobody knows what the president will do next regarding tariffs. We don't know how other countries will react or how other US policy changes will positively or negatively affect the market. My past experience has taught me that even though my current outlook is negative, there are unknowns that might be positive, and I want to maintain some exposure to that potential upside. Also, the income may decline slightly, but it won't go to zero unless the S&P 500 and the NASDAQ go to zero, and that's not going to happen. That wraps it up for this look at BDCs and covered call funds. More Armchair Income coming soon.
Armchair Income, that's my hustle and my groove.